Today we are speaking with government instructor Tim Reynolds about the economic conditions with the Federal Reserve interest rates. So I've been hearing lately in the news that, the Fed, which controls interest rates, they cut them recently after they had increased them a couple years ago. But I'm hearing from a lot of economists that even though they've cut the rates aren't really dropping. And for those of us who don't understand, what does that mean, and kind of what does that mean for the markets and just people?
One of the most important relationships in economics is the price of bonds and interest rates. So when the price goes up, interest rates go down. Price of bonds goes down, interest rates go up. The most important market for interest rates is treasuries. And so, there are treasury bills, which are short-term, treasury notes, which are intermediate, treasury bonds, which are long-term. And so even if the Fed has a policy goal of tightening, which is raising interest rates, if the market, which is huge, the bond market is larger than the stock market. And so people buy and sell trillions of dollars of bonds all the time.
Well, these bonds can be our debt too, correct?
Treasuries are U.S. government debt, but it's also the method by which the Fed uses to manipulate the money supply, by the Fed buying and selling them. But so there are large financial institutions that own treasuries, and there's a group of large financial institutions referred to as the bond vigilantes. If a group of financial institutions who owned trillions of dollars of bonds take it upon themselves to sell or buy, they can manipulate interest rates. Mm-hmm. And so there's some doubt as to whether it makes any sense to lower rates right now because inflation is still reasonably high. Supposedly the Fed is more concerned about what is referred to as core inflation, which is where you exclude energy and food, which is where most people spend their money on energy and food. But they exclude that because they argue that will eventually filter through into headline inflation or whatever. Well, according to what I read, the Fed was thinking that they were going to be lowering interest rates, but now inflation is high enough that it doesn't make any sense to do it in their next meeting, and they meet every 6 weeks. And so now there's speculation that they may not even cut rates all year. So the filter through that is like mortgage interest rates will stay high and credit card interest rates will stay high and all that.
So when the Fed sets the interest rate, are they setting a floor and people can charge higher if they want?
Well, they have a target. One of the things that they pay a lot of attention to is what is called the federal funds rate, which is the overnight interest rate. Banks, by law, are supposed to balance their books overnight. And so in order to balance their book, they buy and they loan and borrow overnight. And so that is very flexible. Yeah, it's a huge market, and the Fed is the big dog, but there's some important institutions.
But if they set a rate, can somebody who's selling a bond say, well, I want to charge a higher rate than what is set? I don't think they can go lower, correct, or no?
Oh, they could, but
because I think that's where a lot of the confusion comes in for people. It's like we assume the Fed sets the rate, that's what it is.
Yeah. But the markets are large. A lot of our bonds are held overseas, but it's largely set by the market. They're just the biggest. The Fed is the biggest player. When I talk about it in my classrooms, I argue, and I think it's correct. The Fed has a checking account for which there's no limit on how many checks they can write, so they can buy as many bonds as they want. They went through a couple of years that was called quantitative easing,
right,
where they were just flooding the markets with bonds and lowering the price, and they manipulate that, and so they kept interest rates at virtually zero. My general interpretation is they kept interest rates too low for too long.
And you feel like this is a correction then from that, or is this the aftermath?
I would say one manifestation of that is you have asset price inflation, like the stock market and real estate. I taught a Monday macroeconomics class, and I talked about the debt, and there's no reason that we would default on the debt because our debt is in our currency.
Right.
One of the ways we deal with the debt is we just roll it over. We pay old debt with new debt.
Right.
But there's no reason for the United States to default on the debt because it creates the money. There's a group of economists who believe that the real cause of inflation is if the rate of growth of the money supply is greater than the rate of growth of the economy, then that alone causes inflation. But also, I mean, look, the federal government is spending trillions of dollars more than it brings in taxes, and so that causes inflation too. Generally speaking, even with all of this mess, look, the U.S., the handout I give to all of my classes, first day of class, is that the U.S. is the largest economy in the world. We produce about 26% of everything produced in the economy every year, but we only make up about 4% of the world's population. We have the largest economy in the world. We have the largest military in the world. We have the most important currency in the world. And the Chinese would like to replace the United States as the dominant world economy, but 60% of all trade is done in dollars, and only less than 3% of all trade is done in the Chinese currency. Mm-hmm. So there's no...
It's not on the horizon.
Even it's not anywhere near on the horizon. Okay. Not in our lifetime. Okay.
With the dichotomy in the interest rates, what does that mean for the larger economy?
Well,
especially with, a new administration coming in.
The complicating thing about Trump, look, real estate people make all their money on borrowed money. And so he's probably going to try to force the chairman of the Federal Reserve to resign, and he would appoint someone who would be more in favor of lower interest rates. But like I say, there's limits on that because of the bond vigilantes. I mean, there can be...
That's what I was saying. Then they can keep, no matter what they do, they can keep them higher. So
they can manipulate, and they can put pressure on the Fed. And there's currently pressure on the Fed not to lower interest rates, but it's because of these active players in the bond markets. Jimmy Carter recently passed away, president. He appointed Paul Volcker to chairman of the Federal Reserve. Volcker raised interest rates to 18, 19, 20%. But the beauty of that was for the next 3-4 decades, they were able to lower interest rates.
Right.
So arguably, it would be better to just raise them, solve the problem, and then you'll have the opportunity to lower rates, which will be stimulating the economy.
Thank you for listening. To learn more about what's happening at ACC, visit allencollege.edu/news.